We're starting recording now, so don't say anything bad. All right. Good good afternoon, everybody. I hope everybody's doing fine. Um, so my polling question was, and I don't even have my chat. There it is. Got my chat box. All right. We're gonna watch. So who's gonna watch the Duke Illinois basketball game tonight? So just type in your chat and say yes or no. You're going to watch it. And so, all right, good. We like this. We like this. Yep. All right. Who is going to win? I was going to do this as a poll, but I couldn't figure out how to put a new poll in here. Who's going to win, Duke or Illinois? Oh, Brian. Duke, sadly. All right, Zach. There's somebody with a little bit more optimism. It should be, hopefully. I'm hoping for an Illinois win, but we will see. Yeah, that is true. Yeah, that is true. If Kofi plays that bad again, Duke. All right. All right, so we're going to get going. By the way, this is the last class. It's hard to believe, is it not, that it's the last class of the semester already? But it is, and pretty soon you might even actually get cold. So let me start sharing my screen. I'm going to share my entire desktop here. First off, here's all the material for the class. So we'll go over this material today. Note that there are 3 links in this item. I put up the final for 2019 up here, and we'll talk about this in a little bit. But I decided to provide a sort of an example of what we did last year for the final. Unfortunately, this year we will have to do something different because we're going to do this online. So we will show that here in a minute. There's also week 14 outline here and then a spreadsheet that I'm going to talk about. So that's our outline. And now I'm going to go to the week 14 outline. So that's where we're at. All right. First, and we'll send a couple reminders of this. Please complete the ISIS forms. So if you wouldn't mind, just do the ISIS forms. They are all online now. I don't even know. There isn't really a link for this class, right? Each student has a link, I think.
Yeah, I think it's individual, yeah.
All right, so you know the routine. Please complete your ISIS scores. All right, which is our evaluations of us. All right, and by the way, if you got any suggestions about how to make this class better, and you don't want to, if you don't want to put them on the ISIS scores, just email me, or I'm more than happy to talk to anybody. We want this class to improve, and if you've got any ways of seeing that, do so. By the way, I want to really thank Enrique this semester. He was obviously our TA, and he did an exceptional job. So just an exceptional job this semester. And he is the one that did all of the Python programming that we've been using for the Colab experience. So that's been really good. All right. So let's talk. So any questions or comments here? We're going to do 2 things now. I'm going to talk about the final project, and then we're going to talk about the final itself. All right. So first off, I'm going to extend and I already have extend the deadline from Wednesday, tomorrow evening, to Friday, December 11th. And most of you don't need that extension, particularly the ones that I saw put their reports together and submit it for review. I was impressed with the care that you took in putting those together. So just a point there. You may not need it, but I'm not going to grade them till this weekend anyway, so we've extended that deadline to December 11th. All right, as I reviewed that those projects, and by the way, on those projects, I also on the website here, comments on the final project I have right here. So if you want to view that, it's right there. And then this VF INX Magellan returns also is there, which is the same one as here. And I'm going to use that to demonstrate some things here in a minute. All right, so that, if you want to get some more review on that, that's here. All right. The major item that I made on your projects was on the period of analysis, and if possible, you should make that as long as possible. And I'm going to illustrate why that is the case here in a minute. And I just made that comment. So in certain cases, you picked assets that probably have a longer time period, and you should use, in my opinion, as long of a time period as you possibly can. And I'll illustrate why that is here in a minute. So if you can extend it, that would be a good thing. Number two, if you can't, and that is the case with a number of your projects or the ones that you selected, I would like you to note that you have a short time period when you go to the analysis of the wealth levels, and that may have an impact on what you're projecting for wealth into the future. And in particular, if you're looking at very short time periods at the end, you will see that may overstate the return that you're going to get over the long run. Okay, so that was the point that I was trying to get there. Yeah, so Zach, so let me tell you, here's what I mean, lengthening the period. So let's say, all right, and let me pull up this example. I'm going to pull up I'm going to go to our website here and pull down the example. What I'm specifically talking about is this right here. You told me how long you used the data to calculate these means, variances, and the correlation coefficients. So if some of you may have done this from 2017 on, for example, or 2018 on, and in my opinion, and most people's opinion, that time frame would be too short. So you need to go back here as far as you can. If you can't go back there, note that you can't, and that this may result in some poorer estimates of what expected returns will look like in the future. All right, does that help? Hopefully. That's what I mean. Okay. Let me read this. So someplace. So that's a good question. Where should you state it? You could state it here would be fine. So that's going to have impacts here on these returns. That's going to carry over through here and then here as well. But if you note it any place in there, I will be happy. Any place along the way. Actually, this would be as good a place as any to note it. Okay, that's a good good question. And I did, thank you for, yep, that I did not make that clear. All right, other questions here that you have as I'm talking through this. So that's what I mean. And so that's what we're going to consider here. All right, I have a couple of graphs here, and I produce these graphs in that VFINX spreadsheet that is on our website. And somehow I got there. It's this website right here, and I think I've already brought it up. Yeah, I got it right here. Rather than download it again, I'm just going to bring it up. Going to make this thing big and make this thing bigger. Oh, I got that. All right. All right. Let me, is that big enough, Enrique, or should I make it bigger?
If you could make it bigger,
How about that?
that's better.
All right. About as good as I can get it. All right, let me go to the top of this sheet. All right, what I did here was downloaded Vanguard 500 Index Fund from 1980 on, Fidelity Magellan. So this is roughly the same type of fund as Vanguard 500, except it's actively managed and it seeks capital appreciation. So this one is an actively managed fund and it seeks capital appreciation. And what you'll see is that it has a higher portfolio turnover and a higher expense ratio, okay? Which is typically associated with actively managed funds. I mean, this VFI or the Vanguard 500 Index Fund, we only had 4% turnover. This one, it was actually over 100%, which means that in one part of the year, it turned over more than once. I took the adjusted closes here and divided it by 1. So each one of these numbers is divided by the first adjusted close, okay? And then I graphed it, and that's the graph that you see that I can't find now. Where did it go? Oh, oops, sorry. There it is. There's my graph. All right. So let me tell you what this graph does. It starts here with 1 here, and then it just explodes, or not, it grows up. And what this graph shows, we're using the adjusted closes, right? If you invested $1 in each one of these investments here, this is what that value would be worth today, okay? All right, and you can see here, VFINX, if you invested $1, it would be worth $72 today, 105. And that's the difference. By the way, that's a big difference, right? My guess is that those two would be pretty close from a standpoint of returns. They would. We'll talk about that here in a minute. All right, what you are doing is picking data, starting at the end and then moving back in time. All right. I'm going to draw a couple lines here just to get us in line here. I'm going to make that a little bigger. All right. Now let's say I pick from this period to this period. I'm going to get a very high return because things have grown pretty rapidly from this period in the later periods. All right, if I pick a different period, all right, if I started right there and pick get it right after the COVID break, I would have a very different return than even back here. It would be much higher. All right, then keep going back. If I start here at the beginning or 2019, I'm going to get a much higher return than if I began in 2018. All right, excuse me. These two, picking the return there versus picking the return there, is going to give us a very different return look at, right? Let me do one other thing here. Let's start at 2000. Let's say you pick a period that begins in 2000. I want you to see something else here. I'm going to draw one more line. All right, let's pick 2000. All right, so if I pick the period of 2000 to begin and go all the way over here to 2008, that decade, you will essentially come up with zero return, right? Because it fell. This was the 911 fall, recession that resulted from this, and it took a decade to get back to where it was at the beginning of the decade. So if you include this period in there, you're going to get a very different return than if you go back here. And one of the ways that you control for this is to take as long as return as possible. And that brings us back to the second table here. So I calculated up here different annualized returns for different periods, right? You can see here that there's differences between VFINX and the Fidelity Magellan. Again, if you picked at the beginning of 2000, and that's your period, you would only have a 6.44% return, and Fidelity Magellan would be below it. All right, and this just gives you a feel for how important that choice is. Now I'm going to questions here, comments. That's why was making that comment on many of yours, particularly for the ones that were pretty short. Again, let me pull this up here. So there's that graph. We've just talked about it. Here's different ranges and what the VINX return is, and then go the next step and put it in the wealth model. And again, this is the wealth model that we put together and you're using it. Most of you have used it already to, it's this model right here. Let me see if I can pull it up here quickly. Yeah. All right, it's this model right here. And if I change this number, this is the ending expected wealth level. And by the way, where you find those numbers is here in this table at the bottom, right? So just go to 2060 and you'll get that number. And let me go back. That's where those numbers come from. So if we did the analysis from 2018 on, that would be 13.38% return. We would have a $5,729 item in a list here. If we add since 2010 on, and you assume this was going to continue, we would have spectacular returns. Put the decade of 2000 in there and you get down to here. Add the 90s, you get back to 9.96. And some of you had like 1995. And actually, you're getting close to this period here. That's why you got so low returns. And then you put the 1980s in there. And the 1980s were in general a pretty good period. All right, so the point is that the recent experience may not indicate what you should expect over the long run. And I would temper that back. All right. And I sort of believe, and this is just my belief, but a lot of people believe this, that we're sort of looking at long run returns here in the 10% to 9% range. So if you're getting way above that, you're going to have much higher wealth levels and so on and so forth. So that's why I mentioned it. And if you can't extend it, just mention it. And, you know, index fund is likely to be in that 9 to 10% range and then go up from there. Okay. So that was that comment. Any questions about the project or what needs to be done there? We good? Just say, type me yes if you're good on it. All right, good. Thank you much, all of you that responded. All right, so now that's the final project. The other thing about the final project, that many of you picked an S&P 500 index and also a treasury fund, which I shouldn't have found surprising, given that I sort of led you in that direction. And that's a very good fund. And I've gotten over the years more specific about the funds that I want to see in there, because in previous years I got some funds that I did not think, investments that I did not think were all that appropriate for a retirement fund, that were perhaps too risky and too low return. So been pushing more in this direction. And if you look at what financial planners do, it's sort of in the ballpark of what they do as well. So that's why I made that recommendation and sort of steered you that way. The one thing that I would say is, if anything, I would personally suggest you be more risky than that. Just because. I mean, you're young. You might as well take some risk when you're young, because you have not little wealth to lose. So put some of your funds in a mid-cap growth and go from there. Okay, that would be my suggestion. All right, questions or comments here? Okay, good. All right, let's do a final exam. And I missed that. All right, I'm going to write the final exam. And I wrote this all out. All right, the final exam, sorry about that. Final exam. Final exam will be on Compass. It will be 25 multiple choice questions. All right, you will have You will have from Monday to Friday of next week to complete it. And you can complete it at any point in time, just like it will be the same format as our midterms. Except our midterms, we had that open-ended question. We will not have an open-ended question this time. I'm having a hell of a hard time spelling today. Midterm. And those are right. All right. One compass, multiple choice. All right. I don't know why that's not saying those are all wrong. All right. So that's the format of the exam. It will start on Monday next week, which will be the 14th. And it will end midnight the 18th. Enrique, what am I missing there?
I guess I would just add that, again, same thing as the midterms. If you have any questions or if you have perhaps a problem submitting it, that you don't need to panic. I mean, just email us and we'll take care of that. And but yeah, I mean, the online class, we have class Thursday. No, this is the last class.
Nope, this is it. This is it. Make no mistake about it. This is it. Just a song from somewhere, but all right. We do not, yeah. All right. So that's the final. So you got two things left. Final project is due Friday at midnight, and then next week you do the final. All right, the final is going to be cumulative, but weighted towards the last part of the class. All right. And the final thing I'll mention is that I put a final 2019 final on our Compass website, and I will talk you through that here in a minute. But should I go? All right. So take them through the topics that are likely to be on there, and then I'll show them last year's final. So that's our plan. So I'm going to stop sharing. I'm going to let you share. All right, Enrique?
Yeah, all right. Let me get it. So there's just one question there on the chat if you want to answer that. Why I want to
No, projects are due Friday at midnight. Friday at midnight. I moved it back.
Sure. All right. Can you guys see my screen?
Yes, we can.
Okay, cool. So I'm going to go over a review for the final exam. I'm going to cover basically the first and second midterm content that you guys did. And I think this is a very good guideline for you guys to study, or making sure that you know how to do or know what they are, those points in the outline. I'm going to go ahead and start. And as I talk, I will try to fill that out, like type a little bit. So you guys feel free to type on yours as well if you want. I think this is a very good outline for getting studying for the final.
Where's this outline on Compass?
Yeah, the outline is on Compass. It should be, let me get there. It's on the very last session here, online session, December 8th. I don't know if you can see that.
Ah, got it.
And week 14 outline. Yep.
Okay. Thank you.
You're welcome. So going back, I'm going to start from the beginning here. Also, I think we showed you guys a couple of times before, but just stressing that one more time. That link is the same that you have on Compass on the very, like on the header here, I think, on the first topics of the course. And I'm just take those floating meetings out. And I think this is also a very good place for you if you don't remember a particular topic as we review something is not completely clear. There's the link for the YouTube videos here, so it might be easier to follow, and maybe you can, I don't know, copy that and make sure that you touched on everything that you want. Okay. Also, the midterm review is here, so I think that's a good place to go. Okay, it's so this review is kind of based on that outline. Well, so starting here in the first part of the course, one of the very first things that we did was talk about this basic toolkit for investors. When we basically here, hang on,
Michael asked where you can find the reference sheet, by the way. So.
Oh, okay, cool. So either here on the outline, or if you go on Compass, go to course outline, and here on the very first one, course outline syllabus, you're going to see here topics of the course. If you click here, it should get you on the same spreadsheet, okay? Oh, you're welcome. Well, so going back here, one of the very first big things that we did here in the course was talk about this basic toolkit for investors, where basically we talked about how to calculate what is and how to calculate returns and risks for a particular asset. And if you guys remember, I have here the homeworks as well. A lot of homeworks actually had something we should do with that, right? But we talked about two measurements of returns, right? Means, which is the average, right? Mean average, and the geo-mean. And I think you guys remember by now, but can someone point out the difference between the geo-mean and the mean, and which one is preferred? I'm gonna try to cast like questions so we can interact, and maybe I don't miss anything here. So can someone just type there, if you remember what is the difference between those? The geo-mean is it's better, yeah, definitely. So you got the point. So and the thing here is the geo-mean, you try to think as that as the compounding, right? It's the same thing as you started at $1 and reinvested the returns over and over and over. So the difference here is due to the volatility, remember? So if you have an asset that is very volatile, if it goes on negative especially, you might have a bigger difference between the mean and the geo-mean. However, if you think, if you are going to calculate that for yourself or for the future, and you are able to calculate the geo-mean, geo-means are preferred. Yeah. Preferred over, let me put everything in red at a time. So geo-means are preferred. And the way to calculate that, we did it a bunch of times in homeworks, but basically the geo-mean you have, let me open homework 3 here. 2 ways of calculating that. I'm gonna focus on that, okay? So you can either have the adjusted close, remember? The adjusted close, I'm gonna just copy here to another sheet here, make it bigger. The adjusted close, period, and this is 0, 1, 2, 3, and so forth. So the geo-mean, the way to calculate that, first you can use returns, and 2, use adjusted close, right? To calculate the returns, you need to do the returns, where you're gonna do, on the first period, you do the current price divided by the previous one, and you have returns here. Remember, it's -1. And you have the returns, the periodic returns. And in order to calculate the geo-mean from that, remember you have to geo-mean add 1. You're gonna add 1 to all of those. So this one plus 1. And then you run formula. Let me put over here the geomean formula from Excel and everything, and take 1 out, right? Remember to subtract 1 after. However, this method is if you have the returns, and it won't work. I think you guys realized on the last homeworks that it won't work with a lot of data. So the alternative way to do that, which is, I find particularly better because you can apply that to a greater variety of things. You get the last adjusted close divided by the first one, and then let me put it here, count of periods. You're gonna count how many periods you have and subtract 1. Remember, this is important. And then finally, you can just do the last one divided by the first. Oops. Last one divided by the first. Again, now, let me see something. Raised to the 1 divided by the count of periods minus 1. So I think I might have done something slightly off here. Let me just do that again. So last one divided by the first one. Raised to 1 divided by n minus 1. The count here is 8, right? Oh, it's 8, right? So what did I miss here? I'm trying to figure. Oh, this one. There you go. So they should be exactly the same, okay? So if you find something different, you did something wrong here, but you should be able to find those the same, right? But remember the formula about using and getting the geomean. I like better than just close 1, close divided by the first, raised to 1 divided by count of periods minus 1, and then minus 1. Okay, so with that we can get the geomean, right? The actual compounding mean here to find returns. And finally, we talked also about annualizing returns, and the formula of, to annualize those, it will depend on the periods that you have. So if you, let me just put the formula here, it's just 1 plus geomean raised to n, right, minus 1, where n depends on the periods of the geomean. So if you want to go from daily to yearly, your n is gonna be 251. Remember, trading days. If you want to do daily to monthly, your n is gonna be 30, or and so forth. Okay, so if you're gonna, let me do like actually weekly to yearly, this because we are annualizing, right? Yearly, your n is gonna be 52. And then monthly to yearly, your n is gonna be 12. Okay, so this is how you analyze returns, and regardless if this is the geomean or the average, regular average, this is how you annualize returns. Okay, so let's say this is daily. Okay, you're gonna do 1 plus that, then raised 251 minus 1. You have here the annual returns on the annualized returns, or annualized geomean in that case, of this asset. Okay. Good on the return part. The other thing that we thought also was the risk. So return doesn't come like free, let's say. And all assets, they also have a risk component, right? And we can measure risks as standard deviation of the returns, remember? And this is a total risk measure. Why I say total risk? Because later on we learn other measurements as betas that compare the systematic risk, right? The risk compared to the market risk, which is slightly different. So the standard deviation here is a measure of risk, but total risk. And the way to calculate that, remember, you're gonna use the returns to do that. So if you have just the adjusted close and you calculated the geo mean using the adjusted close, you're gonna still need to do that and get the daily returns or the periodic returns. And then you can run the standard deviation formula from Excel here on the returns to get the standard deviation here, okay? And something else that we talked about is how to annualize that. So let me just highlight here. Remember, that's his returns, not adjust close, okay? Now to analyze risk or standard deviation, it's basically the same idea of the n. However, the formula here to do that is the square root of n times the STD that you calculated before. So let's say this is daily data and you want to analyze it. Just get this times, and in Excel you have here square root. If you don't know the formula, you can just do also like n, which in this case, let's say 251, and just raise it to half, right? This is the same as the square root. So accept that. And just see if I did the right thing here. No, I did something wrong here. Oh yeah, raise. There you go. So either way, you can do that. And the catch here is just the n. You gotta be paying attention on which n you use. If you have daily data, weekly or monthly, or every 3 months data, the n will change, okay? So this is where very basic, and we did this throughout the whole semester because this is like the base. That's why it's called like the basic toolkit for investors, because you can calculate that for literally any asset. So if you think about buying land, if you can think about buying a business and looking at returns from that perspective, and stock, okay, so and fund. So you can think about that. This is very basic. And we talked briefly about investment schools. Although we focus on the efficient market school, remember, and the efficient market means that all information is already reflected in the prices. And what does that imply? So if you believe the markets are efficient, you believe that, or you don't think that you can beat the market because there's no new information. I mean, you don't have any advantage of against like other investors. So you wouldn't try to beat the market. You're going to go with that. And that's where I think John Bogle and other investors build their philosophies upon. Because if you can't beat the market, go with that, right? That's why invest in low cost fund or index funds and get exposure, but you don't try to pick assets. Okay. I'm not gonna put here as well. I'm gonna put there's value investing. We talked as well, and we barely touched, but analysis here as 2 other possible ways of doing that. But I'm not gonna put much focus on that right now. Okay. Then we moved on to portfolio theory, right? And now we started to talk about this idea of putting assets together in a portfolio, right? And what's the difference between you having one asset and a lot in a portfolio? So we talked about it. And if you look at a portfolio, let's just do, let's briefly talk about this diversification thing. But a good example, I think, I don't remember if you did that in class, but that's a good way to do like so imagine you have an umbrella company here and a sunscreen company here in the other side. When it rains, this guy makes 50. When when it's sunny, this guy makes 50. And if it's sunny, this guy loses 20, and this guy loses 20. Now, you say, if I want to bet in one of them, it doesn't matter, right? I have here my expected returns, the average between those, which is it's higher, but I will sometimes lose, sometimes win. Now, if I mix those together in the same portfolio, I will have always this composition, right? So I have always good returns here. And that's because of their correlation, right? So the correlation, we talked about this portfolio theory. I think this is key in understanding that. And to do that, I'm gonna just open the two asset portfolio that we talked of how those returns will be for a portfolio and the risk as well. So on the return part, if you go here in homework 2, it's very straightforward. If you mix a couple assets in a portfolio, you're gonna have the expected returns, right? Is the weighted average of the expected returns of all assets in there. So if you have like 10 assets, it's just the weighted average of all assets. So I'm gonna just, I think it's over here, it's very straightforward here, the returns, right? Now the risk, on the other hand, this is where there's a catch here, I would say, not a catch, but correlation matters. And remember, I think this illustrated good, this spreadsheet illustrates very nicely here. Let me just put another. Yeah, there you go. So if you have a correlation of 1, they're perfectly correlated. You don't have any diversification benefit at all, right? As it starts to decrease the correlation between them, then the curve here starts to bend to that side. And you guys remember, this is a expected return and standard deviation graph. So the more you go to that side, the better, remember? Because you get more returns with less risk. So as correlation decreases, it goes to 0, you start seeing here this curve bowing to the left, which means that if you look at this particular level of returns or risk, sorry, for instance, you can achieve like 0.5, or you can also achieve 0.8 or 0.9, I don't know, % with the same risk level. And that's because the way that you put those together will give you benefits or diversification benefits here. So that's very important. In fact, that example that I just talked about, the sun and the umbrella company, it's a case where you have a perfectly negative correlation, right? So a -1 here, you will see the EV frontier touching the axis here, which means that you can produce a portfolio with essentially no risk. I mean, this is of course not real, but it's just for you to get a point of that. And so when you look at the standard deviation point of the portfolio, you have the formula, right? Remember, so it's the standard deviation of asset 1 squared, and then the weight squared, and then you have the other assets standard deviation and weights squared, then 2 times the weights times finally the correlation here. Is that correlation here 5? Yeah, C5. So correlation matters here, and I'm not going to put the formula there, but we started talking about this portfolio theory and how to put those together in a portfolio, and correlation matter here for risk. So the lower the correlation, lower the standard deviation or risk of the portfolio, the lower the correlation amount between assets, right? Okay. And so this is what we have here, right? And we talked about a couple more things here. If you look at this 2 asset portfolio model, I'm just put 0.5 here, or let me put it's like -0.2, which is probably somewhere in between some assets that you guys probably found on the final project. If you got this bond fund and an index fund, you got this probably negative or close to 0 correlation. You have some risk diversification here benefits, right? And we talked about the portfolio theory where if you have, and let me just make it, can I make it? Yeah. if you have a risk-free asset here, oops, should be. So if you have a risk-free asset here, and remember risk-free, we usually talked about it as being the T-bill, right, or treasury, essentially no default risk. So we treat that as the risk-free rate asset. But if you have a risk-free here, you would imagine that you have a line here, and then as this line go down to that side, eventually you're gonna barely touch on the tangency point here. And this point, we talked about it, is the point where the Sharpe ratio is the max, remember? And so this will be the portfolio that you would hold if, regardless of the type of investor you are, you would essentially, it's what it tells the portfolio theory, right? That you will hold a portfolio here in between the max Sharpe ratio and the risk-free asset. And where you would hold that will depend on the risk preference of the individual. But this max Sharpe ratio, it's very important here in this case. And I don't think, I think I jumped here, but the Sharpe ratio, it's also, remember the, let's say here, return risk or risk reward, or a bunch of like different names, but it's a measurement returns that are risk adjusted for an asset. So it's just the returns minus the risk-free rate returns, which is usually given, divided by standard deviation of the asset, okay? So in that case here on homework 2 that I'm using, if you wanna calculate the Sharpe ratio here, for instance, for asset A or 1, it's just the returns minus the risk-free asset return, and everything here divided by the standard deviation. Okay, so this is the Sharpe ratio for every unit, and this is important to know how to interpret that. So let's say here the Sharpe ratio is the Sharpe ratio of 0.8. It means that for every unit of risk, this asset gives a 0.8 excess returns over their risk-free asset. Okay, so this is the interpretation. So the higher, I think it's good to point out, the higher, the better. Okay, for the Sharpe ratio, it means that you have more rewards or more returns for every unit of risk that this asset carries. Okay, that doesn't mean that the asset is not volatile or it's not very risky. It just means that the risk-reward ratio is good. Okay. Now, when looking at this portfolio model, this 2-asset portfolio model that we talked about, you guys are doing that on the project. Yeah, sure, I can post that on the Compass later. When you look at this portfolio model, it's very important, and I think you guys are addressing that on the project, but to know what are we relying on when calculating that? What are the assumptions? Because this is a pure mathematical like problem, right? That gives, once you give those inputs, you are relying on those, and those are very, very important assumptions on your model. And the assumptions that you're making here, I think the major ones here is this historical performance that you calculated, or somehow you put here, and let's say I didn't calculate, but I am 100% sure here that, I don't know, Tesla will perform 80% on return next year. So, I mean, I don't know how I got there, but I'm 100% sure that this is my assumption. The same thing is if I got like 3 decades of data and I found that on average this asset would return 5%, is still an assumption. We are relying on that to build our model. So returns will stay the same, right? And by the way, again, in your project, I mean, if you don't agree with I don't know how, if Gary, you got a comment on that or not, but if you don't agree with the historical performance and you want to change that, you can still build a portfolio upon, on that, right? You just need to change your assumption, but you got to be able to sustain that, right? Garbage in, garbage out. This is just mathematics. Same thing here is not just the performance, but correlation and risk, right? Will they continue? So if you got a very large or very long period of data, returns is kind of like, as far as like where they research and what they tell is that returns is very difficult to predict. Okay, it's very difficult like to predict. However, the correlation, the risk, it's more predictable. So although it's more predictable, there's still like this assumption that we are relying on. Because is the correlation going to still be like negative 0.2 here? If it changes, we know that it would, oops, not 5, right? But 0.5, it would change a lot your composition, your optimal composition of the portfolio, right? And same thing here if the standard deviation of the assets changes. So this is another assumptions that you're relying on. And finally, if you're doing that, I mean, you can blend that with some value invested in philosophies, but in that case here, I am assuming that the market is efficient, right? So I'm just taking everything as given. Nobody can beat the market. I'm going to pick index fund, and everything is reflected that. So I'm using that as well as an hypothesis here as an assumption. Okay. So I didn't put here a Sharpe ratio. It's, let me put here tangency portfolio. Tangency point. Yeah. Tangency portfolio. When mixed with risk. This is important to remember as well when you look at portfolio theory. So any questions here so far on portfolio theory? Are you guys following? Is it too slow, too fast?
No, it's good. Good speed.
Cool, cool. All right, so moving on then, we jumped, I mean, the same idea, but now we are using, instead of 2 assets, which is kind of like easier to calculate. I don't know if you guys remember, but you guys went through a thing, maybe this one, you know, 3, 9. Oh yeah, you guys calculated it using Solver from Excel, a EV frontier with 5 assets, or you guys used it 4, I guess. But you guys calculated the correlation coefficients, you guys calculated the expected return, standard deviations, and you guys wrote run that solver thing for a couple times in order to derive the EV frontier. And this is basically the same thing here, by the way, just hide those, that we are doing here on this module. So if you have, I don't know, I was coming up with the same examples here, but this is the same thing that this module does for you guys. Okay, so let me put another. I always come with the same answers. You guys probably you guys must think that I just know those, but anyway. So this is the same thing that this module does for you guys, and what it does is basically for each level of return, it will optimize and get the lowest variance possible portfolio, right? And with that, you're gonna have a very similar shape of the 2 assets one, but now you have all those 5 assets here, and you have the EV frontier that is far apart from them, and that illustrates the risk benefit that you get by putting those assets together, right? The same idea that you guys, we were talking here on the 2 asset portfolio, where's that at? Same idea, but now you have multiple assets, right? Again, how to derive that, we're not gonna ask exactly how to set up the solver again, but it's important like for you to know what is this EV frontier, right? So for each level of given return, the lowest variance portfolio possible, right? So remember, if you are over here, where is that? Yeah, we did that. We started over here, and solver would push us to the EV frontier. We decrease returns a bit, push it to the lowest possible. We started here, it puts us on the EV frontier, and this will draw the EV frontier. So basically, this is what solver did for us. And so for each level of return is the lowest variance portfolio, right? I just put a note here, but I'm gonna take that out because we're gonna be talking about that in a minute. But the thing is, if you include all possible assets that you are considering and putting there, and you don't have a risk-free asset, for instance, you don't want to do that, moving along this EV frontier curve, that guarantees you for that each level of return, you have the lowest variance possible. So it doesn't have to mean that you need to be here on the max Sharpe ratio portfolio. Okay, if you want to put that with a risk-free asset, yes. However, you can remember, and I think, let me put that, let me pick here. Let's say I want 22% of return. So you're gonna move along the EV frontier. So as more return you want, you're gonna be moving, shifting your portfolio closer here up, but you are still making sure that you are the most risk reward efficient, let's say here, return risk efficient portfolio, right? And here you have the weights on how much should you hold of each asset, considering the correlation, their standard deviation, and their returns as well. Okay, so this is kind of like the same idea here, but it's what will define the level of return and where you're going to be on the curve. That's risk preferences. And remember, the more risk loving you are, the more you're going to lean towards here the highest asset, the highest return asset on the curve. And the most risk averse you are, you're going to be here on the lowest standard deviation portfolios here. Okay, so where you're going to be on the line is going to depend on your risk preferences. Now, if you're going to combine that with a risk-free asset, right, and if you truly believe that markets are efficient and you have a risk-free asset, then no matter what is your risk preference, you're going to have the Sharpe ratio portfolio and a risk-free asset, and that will be somewhere in between is going to be a portfolio, right? This is the tendency portfolio. How to identify there's diversification benefits? We talked about it, but it's the shape of the curve. So if it bends a little bit to the left, it means that you have diversification benefits. If it's a straight line, you don't have any diversification benefits, okay? So you're gonna look at the shape of the curve. Where does it start? I think we talked about it, but it's always on the asset that has the highest return. So basically on that point, if you look here, at that point, you're gonna just hold Apple, and this is gonna be your maximum return. And then you start lowering the returns and solving for the minimum variance portfolio, okay? Again, I'm not gonna go over again here, but the assumptions that we are relying on, even on this module over here, are those. So I'm assuming that, I'm using historical data here as a benchmark, but I'm assuming that Apple, this fund, those funds, they will perform the same, right? Or those given returns and standard deviations, and that their correlation coefficients are gonna be like that. If something changes, it will change your portfolio, and that's why funds or managers, they will rebalance their portfolios within time, with time, okay, to address that. I'm not gonna discuss that again. So basically the same idea, but now with a lot of assets, okay? Then we talked about mutual funds, right? Mutual funds, we talked here briefly before about pricing models and performance evaluation, where we focused on two main pricing models, the CAPM, right? And the three-factor model. So the CAPM, I think you guys remember that you will take a measurement that is very important here, which is the beta. And the beta here, if you guys remember the interpretation from beta, this is the sensitivity to the market. I like to call it like that, but you have other definitions from maybe I think this makes more sense. But if you have higher betas, you're gonna have your movements amplified by market movements. So a company with a beta of 2, when market go up by 1, it will go up by more than 1. Now, a company with a beta of half, when markets go up by 1, it will only go up by half of that. So the beta, it's a risk measure, but it's a risk measure. Let me put it over here for you guys. Measure of systemic risk, or risk relative to market. And this is the heart here of the CAPM model, right? So if you remember the CAPM model, it says that an asset returns are equal to the risk-free return plus beta times, and then the market return minus the risk-free return. So this is the market excess returns over the risk-free asset, remember? So basically it says, CAPM says, well, we just saw that if you put a lot of assets in a portfolio, you can diversify a lot of risk. But there are some risks that you cannot diversify. This is the systemic risk. And this is what the investor should be rewarded for. And this is what beta measures, okay? And therefore, the price of this asset should be a function only of the beta. And basically, so the excess returns they just put the risk fee on the other side here. But the excess returns over the risk-free asset is solely a function of beta, right? And we did that as well. We did some regression analysis to find out the beta here. I'm not gonna open that right now, but you guys remember from midterm 1, you got a regression and you can interpret this beta, and which sometimes, if you look at regression, let me just put it, is the coefficient, right? This is the beta. So we looked at that and we talked about how to price assets according to the CAPM model. Now, just a thing here, if you want to, no, let me move on a little bit then, a little bit. So this is what the asset should be performing, right? But now we run the regression on a couple of them, and let me see if I have it here. Probably, maybe I didn't put it here, but we run the regression here, and we found that the intercept that should be 0 in that case was greater or lower than 0, right? And this is the alpha, is the measure of excess returns, remember, comparing to the benchmark. So the interpretation of alpha is the excess returns over the benchmark. I'm gonna have to go a little bit faster here, otherwise I won't be able to do everything, okay? The excess returns over the benchmark here that you choose. This is alpha. And from the regression analysis, this is the intercept, okay? We would expect, let's say, compared to 0. If it's 0, that means the CAPM holds. If it's greater than 0, means that comparing to the benchmark, the asset outperformed the benchmark, you guys remember. And over here, you compare to 1. 1 is the beta of the market. So we talked about those, and we talked also about the 3-factor model. And I'm not gonna talk a lot about that because we don't have much time, but the 3-factor model, it's the only difference between them and the CAPM. Let me just do that. Yeah. 3-factor. It has more risk factors other than simply the beta. That means market. Okay, so sometimes you have like the value minus growth. Sometimes you have the large small factors, small versus large portfolio, and you can break down the risk components, and that might be a better measurement because you have more risk factors that play a role in pricing that asset. Okay, and a good thing of that those pricing models that I just want to highlight here is you can actually compare those with historical returns. Okay, I don't know if you did that or not, but what we're doing here, we are saying this asset is going to perform 5% a year. Now, this is according to historical returns. We calculated that over 30 years. Now, I could have used the CAPM pricing model that maybe yielded, I don't know, 0.8, and I can use that in my model. So this is what the CAPM is for, or the 3-factor model is from, other than just evaluating performance. So alpha will evaluate the performance, okay? And then we talked about funds and how to compare those, right? Equity funds. And I highlighted here key aspects, which are 4 that you should be looking at to rank or evaluate funds here. First is this investment style. In that case here, we talked in that part of the course of stock funds, right? Now, a big distinction here is if they are indexed or actively managed. And remember, the biggest difference here of the index fund, it will track an index. So there's not much turnover. Like, so let me put here index, low turnover. You won't keep like selling and buying new assets trying to beat the market, which is what the active management is doing, right? And the biggest difference here is the expense ratio when it's lower in index funds, or at least you would expect it to be lower, right? Because there's way less transactions and the management is not doing much effort, it's not demanding much, it's not spending much time in trying to develop any strategies, just following an index. And that an algorithm can do that for like fairly cheap. So if you look at the expense ratio, it's going to be probably lower in the index funds. Now, another thing that we talked about is the profile, which is the Morningstar box, I think. And for that, I think we have here Yahoo Finance. Yep, let me just pull that real quick. Go to Yahoo Finance profile. We have here the Morningstar style box that is a good to find out the profile of the fund. And you would have on one side here, and just wait a little bit, and I don't know if it's not going or if it's, try to refresh. But you have a distinction here between small, mid, and large cap, which this is regards to market cap. So a fund that invests in small cap, it means that invests in companies that have up to a certain market cap in the market, so small firms. And also growth, blend, and value. And this is, remember, this is book to market cap ratio. And usually you think of value as being like, I always do that, cement, or like something that is very asset heavy, and growth more like tech stocks, right? That the idea, the goal is grow, as it says. I don't know why it's not pulling it here. Let's see if we would have another one. Yeah, I'll leave it like that. We don't have much time. But this is another distinction, and the implication of risks, expected risk and return. So from the return side, I'll put higher. So it's going to be small, mid, and large. Would expect lower returns. And as far as risk, it's the same thing, right? So small, mid, and large. And the other classification here, let me just put it over here. It's gonna be growth, right? The higher returns, blend, and value. And same thing here as risk, right? More risk, more you would expect higher returns. So this is the classification here, and this is very important for you. And I don't know why it's not. It's, let me put here one box. Investment images. Yeah, so we remember, you guys remember probably that morning box here. And so have increasing risk when it goes small and increasing risk when it goes growth. So a large blend fund was laid out here is going to be less risky than a growth and a small cap one, right? So make sure to address those. And we talked about ETFs and mutual funds as well. The biggest difference being the creation process. ETFs, you're going to collect money and buy shares. I always get confused in that. I'm not going to talk right now because I don't want to say something wrong, but we got to go back to the first midterm and make sure that you have those distinctions here on the creation process. Now, this is the first part of the course. Any doubts or any comments or any, let me go back to some aspect of here. It's going to probably be in 2-3 here, guys, if you guys don't mind, but everything good so far? Can I move on?
Yes.
Thank you. All right, so then this was about equities, right? We talked about equities, portfolios, how to put them together and everything. Remember, equities, I didn't talk about it at the beginning, but stocks are just like the expected or the future cash flows, right? The discounted the stock price is the discounted cash flows from the investment, whatever. But then we talked about fixed incomes on the second part of the course, especially bonds here. So a bond, what is a bond? Remember, I have a debt issuer, usually the government or a company that will issue some debt, and you will buy it from, pay a price for that, and this debt issuer is gonna repay you in some terms in the future. So it's gonna give you a stream of cash flows in the future that for you later on. And we're gonna talk about that, but there is this relationship between the price and the yield that is gonna pay, right? Now, this will vary. So we have a coupon that is paid like every period. And in that case, in bonds, if not specified, always semi-annual periods, semi-annual payments. And the par value is what you get in the end, right? So remember here, the homework 7, I'm going to point out here, you have a par value of 1,000, coupon rate of, let's say, 2%, yield to maturity of 1.5%. You're going to break, you need to divide that in semi-annual periods. So you have the par value times the coupon rate divided by 2. So this is your cash flows all over. And on the very last period, you're going to have your par value back plus the coupon payments, right? And the yield to maturity here, this 1.5, is the same as the internal rate of return of the cash flows if you hold that to maturity, okay? And you gotta always make it times 2 because this is semi-annual period. So the yield to maturity, though, it's always expressed in annual terms. This is important because sometimes you forget to divide it by 2 and this will change the result, okay? So we have this yield to maturity. Now, a debt issue will say, okay, I'm issuing that bond, $10,000 or $1,000 par, with that, and with the yield to maturity coupon rate and the yield to maturity 1.5. That means that if you pay a price right now and hold the bond to maturity with all those payments, you're going to be making 1.5% annually on your investment. Okay, this is what it means. And there is this relationship between the prices and the yields, right? So it turns out that the price that you pay for the bond is equal, and you guys remember, to the discounted future cash flows, right? So price is this cash flows of the bond, okay? Which means that we can solve for the price if you have the term structure here, or the information about the bond, which is what we've been doing over the homeworks, right? We projected those cash flows, we discounted that, and the way to discount that, as we're going to talk about the spot rate, but you can use the yield to maturity or the spot rate curve if you have it. But the point is that you're going to discount those cash flows all the way down, and the sum of those discounted cash flows is going to be equal to the bond price. And you see here a very, this is an equation here. So there's this very strict relationship between prices and yields, which you'll see if you increase yield over here. I think you guys are seeing here. As I increase that, you see price dropping here, right? So as I increase, price drops, and conversely, if I decrease, price increases. Okay, so this is this inverse relationship, but this is important for you to get, because so if you're looking at stock markets, right, yields goes up, you're gonna think that it will intuitively go up, but actually on the bond case, if yields goes up, then prices go down. Okay, so this is inverse related to yields. We talked about zero coupon bonds, and this is a special kind of bond that doesn't have any coupon payments. So if there is no coupon payments, the calculations stay the same. However, you're gonna just be paying something right now for a future cash flow at a single point in the future. So you're just basically discounting this $1,000 on the 20th period here, 10 years, to present value, right? So it's a purely like time value of the money here issue. You're just discounting the future value to present value to find out how much you should pay for that. And a discount factor is the yield to maturity, right? And this will determine the price that you should pay for the future cash flow. Okay, but this zero coupon bond has a name, right? Strip, if it's a treasury. And strips, you have the principal strip, which is, and the coupon strip. We talked about this principal strip, and this is the one that it was on the midterm opening question. It's the one that it's usually you're probably gonna see something like that on the final. Is gonna be probably zero coupon bond. It's a principal strip. That means that you don't have any coupon payments like that. Okay. Now backing over here, we also talked about the duration of the bonds. And the duration of that, we talked about two different duration measurements, which is the Macaulay duration and the modified duration, right? The Macaulay duration, if you guys remember, let me just put it right here, 2%. We have this whole huge equation, right? But it's basically the weighted discounted cash flow by the period, sum of all of them, and then divided by the bond price. Okay, this is the Macaulay duration, and it means the interpretation of that is on average how the weighted periods that this bond is going to make a payment. Okay, now one thing here is also the modified duration when you just divide the Macaulay duration by the yield to maturity. But one key thing to note here is the, let me put here, annual. So if I want that to be annual, I can just divide those by 2 and then run the same thing here. This one divided by 1 plus the yearly year to maturity. Okay. So be careful. If you do a calculation of semi-annual periods, the Macaulay duration is going to be on semi-annual Macaulay duration. So 18 is going to be 18 6 months periods. Now, if you want to convert that to annual, just divide that by 2, and then use the Macaulay duration and divide that by the annual yield to maturity to find the modified duration in annual terms as well. Okay, so make sure of that. And one special thing about the zero coupon bond, if you don't have a coupon payment, the only payment that is going to be made is on the very last period. So the Macaulay duration is going to be equal to the duration of the bond, or the maturity of that. You don't even have to calculate if it's a zero coupon bond, okay? So that's something to know here. Moreover, we talked about the structure of interest rates, and let me just see if I have, no, I'm almost done here, guys. We talked about forward rate, which is the implied future rates. So using a spot rate curve, you can imply what is going to be the future interest rates, right? The big deal here is that you can't lock it. So although this is a expectation, you cannot lock it for sure. And I think that it's good to go over the midterm 2 open-ended question and look at that, because I think this is a very good example of forward rates and spot rate calculations. Now the spot rate is the yield to maturity on this zero coupon bond. Okay, why is that a little bit different? Because it deals with the reinvestment problem. If you have the internal rate of return, you're assuming that you are always reinvesting that. The spot rate takes that out because you don't have this reinvestment problem. So this is theoretically what you should be using to discount cash flows. And what's that? I think you guys remember from the midterm and everything. But if you have a spot rate curve, you can just use that curve. So let's say this was the curve here, spot rate curve. You would just plug that as the discount. Sorry, you're gonna be using that to derive your discount factor in each single period, right? And then using those to do the calculation here. So you can discount the cash flows either using the yield to maturity, but if you have the spot rates, you can use that as well, okay? And then the yield curves, Remember, this is the yield curve. Let me just pull down the yield curve treasuries. You're gonna have a lot of maturities here and the yield, and you're gonna see this is treasuries here as a benchmark. So you're using all these benchmarks to derive the yield curve, and you have this increasing pattern, right? It can be flat or can decrease as well, but it's important to know how it's derived. And this is, again, midterm 2 material, but this is by observing a lot of bonds with the same credit quality, right? I think homework 8 deals with that on the open-ended questions. I'm gonna put that because I don't have much time left, guys. This is a good answer to deal with that. And then the relationship between spot forwards and yield prices. I think this homework 7 here, question 2, illustrates that very good. But you have those 3 equations over here that if you have the price, you can derive the yield to maturity, spot rates, and forward rates as well. So conversely, if you have one, you can derive other. And we did that a bunch of times by deriving the forward from the spot, right? The spot, we did those calculations here using the bond price and the payments or the cash flows, and the yield to maturity as well, just using the internal rate of return on each bond cash flow. That, like that, we derive the yield curves, okay? Now remember, on the first period, they're all the same, but it's a good thing to get this relationship between those, so you can derive those curves if you need, okay? Now, if curve changes and you hold a bond, remember about this, remember about the inverse relationship. If the curve changes and yields go up, the bond price goes down, and vice versa, right? And risk as well changes here. I'm gonna point out here in a minute, but I'm gonna leave you to talk about it. But if risk quality changes, credit quality changes, it will also change here the price of the bond that you currently hold, okay? Now, let me just stop real quick here. Gary, do you think I can go over like 5 minutes quickly on those, or do you guys wanna stop, or?
Let's
I mean,
just,
it's recorded though, I mean.
yeah, so we'll record this, put this up there. I want to thank you all for being part of this course. Good luck. And if you got any questions, let us know. But we're going to record the end of it and put it up there. So I appreciate you sticking through this all. And I really appreciate all you being in class. And if you got any questions, you need anything, give me a call, or give Enrique and I a call, and we appreciate you being in the class. So, all right, go on, Enrique. We'll finish.
Okay, yeah, and yeah, so feel free to stick around. And now, guys, it's going to be recorded. So just finishing here, we have these different types of bonds. We talked about treasuries, essentially no default risk. Special treasuries, we talk about strip, we already talked about, and tip, which is the inflation protection one. You would expect a lower return on that, but it gives you protection on inflation. I'm not going to give you specifics of that, but you're always going to be having the max of the par value or the adjusted inflation par value as well, okay? And remember as well about the real interest rate calculation. This was on the midterm 2, and I think this is good to know as well, okay? Now, there are other types of bonds as well. Corporate, there is a corporation that will issue that. Usually they'll have associated with default risk. Default risks. With default risks. While treasuries, they don't have any default risk. And hang on just a second. So they're associated with default risk, right? And we talked about this credit risk, the bond risk, which have this grade system, where you have the triple or treasuries being the best one. Then you have AAA, AA, A, then the triple B, and so forth. And as you move down on the scale here, you have greater default risk. And the greater the default risk, the higher the yield associated with that usually. And we talked about this default loss rate, remember? There's this recovery rate and also the default, right? Default rate. And you multiply those, remember, look at the formula so you can have those for the fund, right? And finally, comparing those bond funds or yields. So essentially this applies to a bond, but it will apply for bond funds as well, okay? Four key characteristics: duration. If it's a typical increasing curve, then more duration, more yield. But however, the duration, if it's increasing or not, higher duration, more sensitivity to yield changes. And we talked about that when we talked about those bond funds, those that would hold like long-term bonds and the other ones that would hold like short-term bonds, the variation and the returns on those comparing those, remember, funds. Now, credit quality, again, you're gonna have the lower the quality, higher the yield. And if you get your bond upgraded for, let's say, from triple B to A, so you are upgrading your bond, you should require less returns, therefore your price will go up. So there is this relationship as well if your credit quality changes along the way. Inflation protection, if have inflation protection, this is gonna be lower yields, right? And tax exemption, usually municipal bonds will have those. Also, if have so, lower yields as well, okay? So those are the four criteria that we talked in comparing bond funds. And I think if you go over the review of the midterm too, that will be a good exercise for you in sorting out in terms of yields, which you would expect to have a high yield or not across different bond funds. And remember, if yield changes, prices will change in the other direction, and that will characterize either capital gains or losses depending on the movement of the yields here in which direction. This is how it will affect this bond funds, and this is the difference between bond funds and different bond funds, in bonds, which is you have fluctuations, meaning risk. So if you have a bond fund, you have risk associated with that because the yield curve changes and price changes, and you're going to incur capital gains or losses. So it's not because you have a bond that holds only treasuries that you're not going to have movements in capital gains along the way. In fact, if you have fluctuations in holding a treasury, you will also be having capital gains or losses if you sold that beforehand. So you can always also sell the bond along the way, and the capital gains or losses will depend on the first yield that you got, the price you paid, and the current yield, okay? And finally, returns are back looking, yields are forward looking. This is very important as well. So it doesn't necessarily have, so we have like this yields decreasing over time, but bond funds returns have been high on the last years when it happened. So returns back were like going up, and now yields were going down. So remember, this is important to get this difference between them. I don't see much people, but there's some guys still here with me. So I think I touched in all the points here, maybe not in super much detail at the end because of time. But is there any question or comment in the end here? If you have, so feel free to email us as well. I think if you go over the first and the second midterm, you will be more than good to go. Okay, so I think this is a very good outline. And again, review your midterms And I'm not going to go over this other discussion here, but I think I've covered enough. So with that, Gary, I don't know if you have something to add, but thank you guys for the semester. You know where to find me if you need something. And that's it.
Yep. All right. You guys have a good rest of your day, and remember your final project is due at Friday, and then the midterm will be next week. So we will see you all, maybe without mask, around the bend. See y'all later.
See you all guys. Bye.